shift focus then, the Multi-Commodity Exchange has rolled out nickel future contracts effective August 18. The new contracts are designed to give nickel-consuming industries a robust price risk management tool, helping them stay competitive in these volatile times. The trading and delivery units are set at 250 kilos and 1,500 kilograms respectively, with the last trading day fixed on the third Wednesday of the expiry month or the previous working day in case of a holiday. To decode what this launch means for the market and industry participants, we are now joined by Rashmi Nihalani, Head of Research, Strategy and Training at MCX. Rashmi, thank you so much for taking your time out and joining us here on ET Now. So MCX has launched nickel contracts. If you can tell us, nickel, it is a major raw material for stainless steel industry. How will it aid consumers of stainless steel, and how will it help the entire ecosystem?
So, nickel is essentially the largest raw material for the stainless steel industry. A good 70% of the stainless steel cost is largely nickel, and the fact that it's a fully imported commodity in India. We do not have nickel mines. We do not produce nickel, and since it's completely imported, we are totally dependent on the international price movement, the supply chain disruptions, and hence we really require a platform for the Indian importers as well as the stainless steel industry, that is completely dependent on the vagaries of the international prices. To have a platform in India price discovery to be able to manage this price risk. So I think as far as the ecosystem is concerned, to have a price discovery platform within India in INR terms would be an extremely good offering for them to use this as a great hedging tool.
Okay, and Rashmi, if you can tell us, how are these nickel future contracts different from the existing future contracts that we have? It could be either nickel or other commodities that are currently being traded on MCX. How do these stand out versus the others?
So, as far as the previous nickel, we had a nickel contract earlier, but, the one that we have now, there is a difference in the trading unit and the delivery unit. So the trading unit today, the September contract expiry and onwards, the trading unit would be 250 kgs and your delivery unit would be 1500 kgs, which is different from the previous contract where the trading unit and the delivery unit were same. Also, we have, only a single delivery center where we'll have only Thane as a delivery center for anyone who would wanting to be, giving or taking deliveries on nickel. Also, what we have now done is that, the expiry of the contract would be on the third Wednesday of the contract expiring month, unlike a last day expiry that we had earlier. So this is how it stands out differently from the previous nickel contract, as well as, the third Wednesday expiry is also how it stands out differently from our other base metals contracts, where, the expiry is at the end of the month.
Understood. We get that point, but Rashmi, if you can tell us, what are your expectations when it comes to volumes and liquidity of this particular futures contract? Will it be liquid enough for traders to actually trade in these nickel contracts?
So, once you begin a contract, there is, of course, a lot of ground level effort that goes in terms of, educating the markets, the value chain participants, the financial investors. You need to bring that entire value, that entire ecosystem to be in place. So what we really look at is a very steady pickup over a period of time, that this contract should have. And, also for the ecosystem, like I said, while this will build up over a period of time from the perspective of, bringing in all the stakeholders to be able to participate, I think it's going to be a very good contract for, the financial market participants, as well as, for the actual, value chain participants, given the fact that a need for hedging is really required in this particular contract.
We get that point. Rashmi, thank you so much for